Sure, it's safe. Oh,
That's a revision on it.
It's to go back over the basics again now.
So we'll put that in the front, so.
Yeah, I don't do that now there tonight. Bring the questions in.
Jonah?
Okay, so capital gains tax. Okay, so what I have, we've got 4 handouts. Okay, we've got this one, capital gains tax with little boxes on it. Okay, so back here. Okay, which is this one. Okay, it's in all in the boxes. Okay, and there are notes behind that then as well. This is all revision of what we already have done. I'm going to go through all that tonight just to get us back up to speed with capital gains tax. And you have a pack of questions, which are coming from questions you would have already done before, but it's just to get capital gains tax into the heads again from doing questions. Okay, so that's your question pack. And then we have more notes on capital gains tax, which looks like this one. Okay, this one. Okay, so this is the basics plus more stuff added onto it. I'm only going to do the basic stuff tonight. And then you've got a capital acquisition tax one as well. Okay, so what we're actually going to be doing is capital gains tax, capital acquisition tax, stamp duty, and succession planning. So we're kind of putting all this together into one thing. So we'll be doing it tonight, and then we'll come back probably for 2 more nights, because there's a lot to actually cover in it, because you're linking in capital gains tax and capital acquisition tax. You think of someone who sells something, so say a father gave his farm to the son, daughter, whoever, family member, okay, you're kicking off capital gains tax there, but then the daughter or the son or the family members after receiving the property, and you're looking at capital acquisition tax on the other side, and your stamp duty implications. So it's all about doing the capital gain tax, doing the capital acquisition tax, doing the stamp duty, and then we have succession planning, which brings them all in together, where someone is making out their will, okay, and you're told what they're actually going to be gifting each person, and you have to work out what the tax liability is for the person maybe giving the gift, or someone who has the inheritance, or someone who's getting the inheritance and getting the gift. And then we have capital gain tax for groups in as well, where we've got shares being sold and buildings being sold between each other. And we'll have companies being incorporated. So say we've got a sole trader that's going to incorporate itself into a business. How will that affect our capital gains tax as well? Because there's 2 separate legal entities. You've got sole trader as a separate legal entity, and the company is a separate legal entity. So we're dealing with all that kind of stuff. It's actually alright, you know what I mean? It's interesting enough, but that's my point of view anyway. You might not think so after it. But it's something, you know what I mean, that everyone eventually will come across in a real life situation. So hopefully it'll be alright. Okay, so I'm going to start with this handout here. Okay, so that's the one with the boxes in the front of it. And I'm starting on page 7 of that. so capital gains tax, our tax year is running from January to December 14, and our capital gains tax rate is 33%. The filing date is 31st of October 15, so for our forms, you put them in there, Form 11, or Form 12, or a CG1, that's how you actually make your return. A Form 11 is what a self-employed person makes his return on. A Form 12 is what the PAYE worker would make his return on. And then a CG1 is someone who's not making any returns but sells an asset. Then they'd return on a CG1. Okay, there's a surcharge for late filing capital gains tax returns. So 5% if made within 2 months of the 31st of October 15, and 10% if made more than 2 months after the 31st of October 15. And that's the exact same as we have for income tax. Okay, so our payments, and you have 2 payment dates for capital gains tax. So we've got a disposal on the 1st of January 14 to the 30th of November 14. You must pay your tax by the 15th of December 14. And then if you have a disposal in December 14, you pay your tax by the 31st of January 15. So there's 2 payment dates to actually remember. So you're better off really selling your stuff in January, not in December, because in January you have like 11 months to actually get your payment in. But most people just sell the item, work out what the taxability is in it, and then send off the tax straight away, so they won't actually have the money spent. Okay, the charge of CGT then. In order for CGT to apply, the following must arise. There must be a disposal of an asset by a chargeable person. So in order for capital gain to arise, necessary that an individual actually dispose of an asset. A disposal can take many forms. The most common form of disposal are a sale or a part sale of an asset. However, there are other circumstances that are considered to be a disposal of an asset for CGT purposes. So if you go over the page there, okay, so anything of value that the person owns, we're talking about land, buildings, motor vehicles, jewellery, shares, paintings. Okay, they're the most obvious ones. And the following items are specifically included by tax legislation in charge of CGT: options and debts, any currency other than euro, property created by a person disposing of it, goodwill and copyrights. Goodwill might actually come in some of your questions, because when there's a business being sold, goodwill might actually be part of the question. Okay, we've got gifting an asset. So where an individual gives an asset away for no consideration, or consideration is less than market value, he is deemed to have sold the asset for market value of the asset, and his liability will be calculated on that basis. So you've got like someone who, say, the father or mother gives their son or daughter an apartment, and they charge the son or daughter €10,000, but if they sold it to me, they've got €200,000 for it. They pay tax on the market value, which is 200,000, even though they've only got €10,000 for it. Exchanging one asset for another. Where there is an exchange of assets, both individuals are deemed to have sold their asset for market value and purchased a new asset with the proceeds. Okay, so that's exchanging one asset for another. Then on our next page, we've got granting an option or a lease over a property, and this is treated as part disposal of an asset. Do you remember when we used to be doing case 5 income, you'd have a lease of 30 years, and you'd have a little formula to work out how much it was taxable and then how much it would go over to capital gains tax. So that's what they're talking about inside there. Receiving capital sum in exchange for the surrender of rights to an asset. If a landlord receives a premium on the lease, and then receipt of insurance proposed in an asset, and this will be treated as a disposal of the asset. So if you own a business and the building burnt down, and you actually got an insurance claim for it, then that's as if you actually had sold the building, getting the insurance claim for it. And it's when you receive the money, we're going to do that now in a minute, when it actually becomes taxable.
Is there something about that then? Like if you say the building burns down, you get tax, you get some insurance back, but the money goes back into rebuilding it. Is this money claiming back because otherwise you're paying tax on your insurance?
Well, you see, probably the cost of the building will outweigh maybe what you actually got from the insurance.
Yeah,
So when you're
paying tax on the insurance.
on the insurance, yeah.
And then the insurance goes back, so should you insure the building for like
higher.
3% to whatever it is.
We won't get overpaid by the
You won't
insurance.
get overpaid by the insurance because they value the site and everything out of it like first.
Yeah,
As well.
but it's strange if you pay tax on it, so when you're rebuilding the building, you're only getting what the building's, the cost
The cost back
of the building, not the actual value of the building.
Yeah, I'm not sure now why, but I actually have never seen one where it's gone through like that. It's normally, you know, a clean cut. Do you know what I mean? It's like, and the money just goes back into actually building the building again. An asset passing, okay, an asset law deemed to be disposed of, it is scrapped or destroyed. And that would be like, you know, for if you use an item in a business, then, do you know what I mean, that's what I'm talking about inside there, if it's scrapped or destroyed as well. Okay, assets passing on debt. Where an asset is transferred on debt of an individual, this is not treated as disposable for CGT purposes. Okay, that's important. So when someone dies, there's not CGT, doesn't kick off CGT. If an individual dies, no CGT arises on any asset that he owned. The assets are transferred to the beneficiaries of his inheritance at market value on the date of death. This will be treated as the deemed cost of the asset for the beneficiary if the asset is subsequently disposed. Okay, so that will actually be his cost, okay, at that date. That's why, you know, when there's someone dies, there's always valuations on the properties and all the land and all the assets they actually have. That's to get the market value figure for the new person getting the assets. Any difference between the original cost of the asset and the value at the date of death is never taxed. That gain is if any, effectively dies with the individual. However, if there's a loss arising, this will also be ignored. Okay, so you don't get a gain and you don't get a loss. Our next one is time of disposal. And if you go up to the very front page, page 1 there, I actually have this just done in a shorthand way, just to make it easier. Okay, so it's the second box on there on page 1, time of disposal. So our first one is disposal by contract, the time when the contract is actually signed. You've got a conditional contract when the condition is satisfied, and that'd be like maybe if you sold a site subject to planning. So when the planning, that condition, the planning goes through, then that actually becomes taxable. Compulsory purchase order, earlier the date the compensation is agreed or the time of entry by the authority. And it's always going to be usually the earlier of the time of the compensation is agreed. So someone is not going to hand over their property until they've decided how much they're actually going to get for it before someone actually gets in there.
Just compulsory purchase. They don't hand you over anything.
Well, they're giving up their house, like, or giving up a piece of land or something.
What's that? Is that like if you were giving it for a new road or something?
New road, yeah, exactly.
Yeah.
They advertise on the papers there sometimes when they're starting to build a new motorway or a new road, they list on 2 or 3 pages of the examiner what lands are actually going to be, aren't they, purchased. So compulsory purchase order for farm land for road widening, when compensation is received, the person making disposal must be engaged in farming, okay, when the compensation is received. Okay, it's not when it's not when it's agreed, it's when it's actually is received, when you actually get the money into your hand. And sometimes that takes a few years for the road widening ones, for the money to come through. So maybe, I've heard of someone there where they got compulsory purchase order back in 2002, but they're only after receiving the money now in 2014 for it. Yeah, so it's probably maybe to do with EU rules or something, that money's only coming through now with motorways and stuff. Sorry?
Haggling over prices as well.
Yeah, but the land is gone anyway, but they're in their money.
Fight over the price.
Yeah, and the important thing there is the person making the disposal must be engaged in farming. If they're engaged in farming, this capital gains tax rate they would have applied back in 2002 will apply when they receive the money now. But if you're not engaged in farming, you should have made your capital gains tax return back in 2002, otherwise you'll actually be charged interest up along for not paying the money.
Well, if you were in 2002, would you not know?
If you what?
If you were farming back in 2002.
Oh yeah, as long as you were farming then, yeah,
At the time
at the time of the agreement. And then capital sum, the date the money is received, and that would be like an insurance policy when you receive the money from that. And it's just to show you, there's a question there on that. It's on page 8 of the question pack.
Do you know what year that was?
It's May 11. These are just all the accounting addition questions in all that pack, because they're just like, they're the ones you have to just practice on just to bring you up to speed again. Okay, so it's question 3 there, part A. So Harry signed a contract that said 10 acres of land on the 13th of May 2014. The land was transferred on the 15th of June 2014, and Harry received his sales proceeds on that day. Okay, so when you've got a contract, okay, go and buy your thing. Don't spoil by contract the time when the contract is signed. So he signed the contract, sell the acres on the 13th of May, so that's the date. Okay, he'll actually be liable to capital gains tax. The date the contract is signed. Okay, in November 14, Paul's house was destroyed by fire. In February 15, he received 300,000 in insurance compensation. So that's our last one there, capital sum. Date the money is received, so it will be February 2015 will be his capital gains tax. Okay, then Joan had her house compulsory purchased by Dublin City Council. In May 2014, they agreed compensation of 500,000. In June 2014, they entered the property, and in July 2014, Joan received her compensation.
So it's what you received?
It's when they agreed to when they compulsory purchase, or if the date of compensation is agreed, or time of entry by the authority, so it'll be when they agreed compensation, so it'll be May 14.
So how's she supposed to pay it if she hasn't got the money yet?
Well, she got it in July 14.
But she has to.
So she has until the 16th or the 15th of December
Yeah,
to
well,
pay it.
well, if you agree in December and didn't get the money until February or March,
You're supposed to come up with the money. I know it's yeah, which can happen, like, yeah. It can happen quite easy, like, yeah.
So what
The other thing is leave yourself open for interest and charges, you see, that's what you leave yourself open for.
So if they agreed in December, she'd have to pay it in December.
She'd have to pay it by the 31st of January.
Or 31st
She
January.
wait
Yeah.
in February, March, she had the money like.
So because
Yeah.
she got it in, if they agreed in May, she has until the end of December.
Until the 15th of December to pay it. Just as an idea of like how little questions came in there for the time, the disposals. Okay, so that's our time disposals. That's just a note on long way there on page 10, is it? But I think it's just handy sometimes just to have it in bullet points there instead of having to reading through 3 pages. Okay, our next one is exempted assets. This done in shorthand as well. If you go to page 3 of the handout, okay, exempt from CGT. We've got government and other securities issued by semi-state bodies. We've got life insurance policies with respect to the insured person. Assets held by a charity for charitable purposes. Winnings from a lottery or prize bond. A wasting chattel, okay, which has not been used in the business. Transfers between spouses, and then non-wasting chattels which proceeds are less than 2540. And we'll be going through them as well. And then the top one, principal private residence. That's as long as you've lived in the property the whole time you owned it.
It's the last year or something.
Sorry, last year's always given as.
Even if you're not in it, you're given
Yeah,
it.
you're given it, yeah. As long as you've lived there the whole time and you haven't used it as a business job address and as your principal private residence. Because if you use it as a business, you have to proportion a piece of it to other use, do you know what I mean? Because it wasn't all your principal private
If you did
residence.
rent, you have to have lived in it for 1 year or something, haven't you?
What's that?
You had to have lived in it for 1 year or something, isn't it?
No, you said in Ireland you can, it's the rules when you live in the house.
Like,
It's
if
3
you-
years.
3 years.
3 years.
3 years.
You have to
you're
have
going
lived
to
for 3
yeah.
years, is it?
Yeah, 3 years.
Okay, and then you can rent it out for
Then you have to
another
wait
Yeah.
in the house.
Yeah,
The
3
last 12 months is over.
The last 12 months is always, is always, even if you're not living in it, the last 12 months is always deemed that you have lived there. I don't know why it's a rule, the revenue made up along their way. Okay, so they are exempt from CGT, and that's the exact same thing actually on page 12. Then our next one is a chargeable person who is actually liable to capital gain tax in Ireland. Okay, and this will depend on the domicile and residence status of the person making the gain. Do you remember your resident, ordinary resident and domiciled? The resident is a resident in Ireland for 183 days, or 280 days over 2 years. Ordinary resident, you get 3 years, you must be 3 years resident in Ireland, become ordinary resident, and you have 3 years when you've left Ireland before you actually lose it. So ordinary resident, it's 3 years to get it and 3 years to lose it.
What's domicile then?
Domicile where you're actually from. So like you have a domicile of Ireland, and say you move to a different country, then say you move to America, okay, and you became a citizen in America, then you take on a domicile of the US. But it's actually, you must actually show that you're never going to actually move back to your own country again to actually get rid of your domicile. So you're nearly always taking that your domicile is you come from your father, your origin.
So if I was to move to the US for 10 years, I'd still be domiciled in Ireland.
To be domiciled in Ireland.
So
Yeah.
that's like if you're a refugee, then you would have a domicile in the US if you,
If you
Well,
show
never go
that you're not going to go back.
but ordinarily that wouldn't happen for most people.
No. So that's what resident, ordinary resident and domiciled are. So if you're a resident, ordinary resident and Irish domiciled, your tax will earn on gains arising on disposal of worldwide assets wherever they arise. So wherever you sell property, land, buildings, anything at all, you're liable to capital gains tax in Ireland. Then your resident, ordinary resident but not domiciled, you're charged with CGT and the remittance basis, all gains on specified assets and other foreign gains to the extent that the proceeds are remitted to Ireland, and no relief is given for loss on assets situated outside of Ireland.
So if you sold the house in Spain, actually.
You actually didn't bring,
You
you didn't actually bring the money back into the country. It's when you actually bring the money into the country, you actually start to be capital gain tax on it.
And do you know, if you did that now, say in like 5 years' time, you did a bank in Spain, after 5 years you bring it into the country,
Then
you're supposed to be
you're supposed to pay capital gain tax on it then,
Can I ask you a question? If you sold your house in Spain, but you lodged the money into an English bank account and you're living in Ireland, do you have to pay tax on it?
No, it's when you actually bring the money into
You
Ireland.
don't have to pay anything in the UK.
No, I'd say not.
Is it
Unless Ireland, unless England have more, I would know the English rules now, but it's when you were actually going into Ireland, you were going to pay capital gains tax here.
That's spot on.
Yeah. You just move it around there in a different country.
You're not supposed to have foreign bank accounts, right?
No, and the revenue are going in a lot, and people have foreign bank accounts.
So I have dual nationality. So I've both passports, so I've bank account in England and bank account here as well. Nobody does anything to me over that.
And if they're looking at people who have, say, English credit cards, and they're using English credit cards in Ireland, why are they using them?
But like if you
Not necessarily, actually.
if you go and try to get a job in the UK, you have to have a bank account.
Oh yeah, but no, it's like what they're looking at is like, it's not like just like people do have English accounts and stuff like, but it's like if you're, but the thing is money being ciphering off your Irish income and being put into
Just
your
Swiss bank
English account,
accounts.
you know, and you're not paying all your taxes and
Swiss
stuff
bank
on it.
accounts are more concerned with anyway. Like
And
offshore accounts.
the revenue have access to all our credit cards card information. Do you know, they can see exactly what we're, it's mad like. Do you know, they can see everything.
And can we ask them for a file of what they have on for us?
Oh, I don't know, I suppose they'd have to
Yeah.
ask, you can ask, we might not actually get. Yeah.
I don't know how much you know.
Yeah, I
So
got
that's
to
why I
know
want
that.
to mind.
That's what I know.
But everything is linked up now, like, because the banks have to report to revenue with all the
Yeah,
deposit
sure.
interest and stuff like.
Whereas they will access the bank accounts and everything, you all the
Yeah,
bank account
all the
details,
bank account
sort codes,
details. So like if you're say you were earning 10,000 euro in interest, say, okay, they can see that, but you've actually only returned 500 euros like in your form 11 or form 12, then like they're going to be, you know, like what will be all is paying deposit into anyways, PRSI. Do you mean there's no UST in deposit into, so just better off getting all your accounts and just declaring them. It's actually just
It's easier.
a lot easier in the long run. Okay, so then our last one is neither resident nor ordinary resident nor domiciled. So you're not resident, you're not ordinary resident, you're not domiciled. Taxable gains on specified assets. And our specified assets are listed below. So land and buildings situated in Ireland, minerals and mineral rights in relation to resources situated in Ireland, and that's it, if you put on after that, on the continental shelf. So like you're talking about, you know, oil, gas, all that kind of stuff.
Yeah, that doesn't really happen. Like anything you buy land, if there's a specific clause in it, so it doesn't even
It does include that, yeah.
Instead, I don't think we really know that.
Then any assets situated in Ireland and used for a trade carried on in Ireland, and then shares derived from more than 50% of their value from either A or B. And I just have given you on the front, it's given, if you want to reference it back, it's on page 3 as well, just done in a little box there for you too. Okay, then we've got exempt persons, irrespective of resident, type of assets, etc. Certain persons are not charged with CGT on any disposals. These are trade unions, local authorities, county councils, health service executives and VECs, regional tourism authorities and miscellaneous government agencies. So whatever they sell, they actually don't have to pay any capital gains tax at all. Okay, we've got our computational rules, and an easy way to actually put that down is actually just give you an example of just putting in a computation just to show you. Okay, so we've got a capital gains tax computation. Okay, and for every asset you sell during the year, you do a separate capital gain tax computation for it, and then at the end of the year, you add up all your gains, or you have your losses, and you return your capital gains tax on that then. For every asset is done separately, you don't just put them all in together, you do each asset separately. So you start off with your proceeds. Okay, and your proceeds can be either the consideration you received, or it could be the market value you're actually taking. You actually might have got no money for it, as the market value figure you're actually taking. Okay, so that's our proceeds here. So where are the indexes here? Okay, so our proceeds, and that can be our consideration received or our market value, okay, our market value amount. Then we've less our incidental costs. Okay, less incidental costs on of disposal. isn't it? Okay, so let's run into cost of disposal, and that would be our auctioneer fees, legal fees, accountants fees. So any fees that we have in relation to disposing of that asset. Okay, and that's taken off of our figure above the top. Give us a new figure here. Okay, and then we've got our costs. Okay, so that's the cost of acquiring the asset. Okay, then plus incidental costs on acquisition. And this would be the same thing. We could have auctioneer's fees. If I want auctioneer's fees, we're buying it. Probably legal fees, sisters and legal fees. They'd be the most likely when we're actually buying it. Okay, and then we have to apply indexation. Do you actually have your manuals with you? No, I don't bring it and she's looking for it. I'm just seeing.
Use a separate bag to carry that in.
Yeah, it's very heavy, alright, isn't it? I was looking for it. I'm sure there's a chart in there. There is too. On page 362, the indexation chart. Okay, and remember, do you remember for indexation, it's going based on our tax year? Okay, just keep a note on the tax years here. Okay, so our tax years.
This is separate.
Yeah, it's just to do the 6th of April rule. Do you remember the 6th of April, the 5th of April they were going before? So our tax years, they ran from the 6th of April to the 5th of April up until 2001. Okay, so for every year from when the capital gain tax started, and capital gain started in the 6th of April 74. Okay, so that's when capital gains tax started, 6th of April 74. Our tax year ran from the 6th of April to the 5th of April, up until 2001. Then it's actually broken up. We had 1 year going from the 6th of April 2000 to the 5th of April 2001. Which was the 2000-2001 tax year. Okay, 6th of April 2000 to the 5th of April 2001. Which are the 2000-2001 tax year. And then we had from the 6th of April 2001 2001. Which is our 2001 tax year. So it's a short 9-month tax year. And from then on, we have January to December each year. 2002 onwards. The January to December tax year. Okay, so for the G, we had we sold an asset on the 30th of April 98. Okay, so we sold an asset on the 30th of April 98. It falls into the tax year 98, 99. And you just go into your 98, 99 on your indexation.
That we bought, so that's it was bought in April 98, is it?
Yeah, it was bought on 30th of April 98. This was just laid out.
So it's when it's bought, not when it's sold.
No, when it's bought, yeah.
That makes sense.
So it's expenditure incurred in tax year to the 5th of April 99, 98, 99. So it's 1.212.
And what's the thing then if it's transferred in ownership?
What's that now?
Like as a gift or something, was there something that goes back to the...
That transfer between spouses. Yeah, we'll be doing that there. If the spouse, say I transferred an asset to my spouse today, okay, but I had bought it back in 2000, then it's when my spouse sells it on, it's the date in 2000 is the date that they bought it, not the date it was actually transferred over to them.
Is that the only exception to the rule?
I think so. I hope, yeah, I'm sure it is, yeah, yeah.
But if it's,
But
if it's
will
given
be
to,
paying when they will be signed.
Sorry?
The spouse will be signed, will be
It'll be the first date, the date you actually, the spouse who transferred it bought it, yeah, they
then
then
if
bought
you give
it.
it to a child, then it's different, it's disposed.
It's different, it's disposal straight away.
disposal, and
Yeah.
they've got it on the
Yeah, and you have to pay capital gain tax on it. Yeah, so you transfer between spouses, there's a bit of leeway.
They're not going to give us something like that was disposed in 2001, 2002, and that it's going to be all just...
Oh, it'll be 14.
It's always that.
It's always the last one you actually look at. And Richard actually sent me on, I'll actually email it on to you. Tax reference to you, but it's only 3 pages, I think.
Is there less so than what was in the other one?
Yeah, it was specific to what's on the exam, say.
Oh, good.
So
So
you
is that this is the current one for this year?
Oh, still come out, the whole and so.
Seriously, like, because we need to practice.
Handy for all, I have my doubts.
It's not my email tax me or reference material for when we get it.
So some of the stuff in there, we added off, questioned it off, so is it?
Or do they only give us 1 page, but like...
Yeah, it just like specifically what's on that exam that day.
It's good because you can't get confused.
That's good.
Yeah.
Some of the stuff that we don't actually know about, it's not in the...
Then you won't get any hints from any of the other bits and pieces. It's true, I suppose.
Oh, it's not in the login. But I emailed on to there, because he's in me there last week. I emailed on, it's very short, it's grand. Like, I just wanted to check to see, do you know, we're normally used to seeing 99 to 1000 or, do you know what I mean? It's just slightly different. Yeah, I just wanted to see, is it the same as that, or is it the other way, just so we're used to which one they actually use. Yeah, the year ended, yeah. So 1999 is like 5th of April 99.
And the questions, because you've been looking at them, they're not going to ask us to do a report to someone about this, are they? They're going to ask us for a computation.
I think there was letters and stuff.
So
yeah.
could we just feed that back?
Yeah, yeah. As well as computation as well, then. Yeah.
Not necessarily.
Okay, then we applied our indexation. Okay, that's give us our index cost.
Wherever budget or- yeah.
Okay, that's our index cost here. And then we might have enhancement expenditure. So say we bought a building and we actually put an extension onto it, then that's enhancement expenditure. And we
Another indexation.
Sorry?
And another indexation.
And more indexation then, yeah. So it's indexed up again. And that's the date of enhancement. Okay, not when we bought it, but it's the date of the enhancement.
So if you bought in 98 and went up in 05, you'd use 05.
Yeah, 05, yeah. Okay, and take them off to give us your gain. Okay, and say that was the only gain we actually had. We ignored the gain during that year. We'd have an annual exemption off that. With of 1270 at 33%.
That's still about 270.
Yeah, 127. It's only one you get for the whole year. So if you're 10 gains, you only get one 1270.
That's where you benefit if you share it with your spouse, because you can get it twice.
You can get it twice, yeah. So like if the building was in joint names, you could get 1270 and she could get 1270 or you could get 1270.
That's still 33%, isn't it?
So 33%, yeah.
That goes to next year, no? You know, just-
I don't think so, no, it's still at 33.
What we don't think we get from 33, what was that? Was that,
The dirt tax,
third tax?
up to 41. Excuse me. And it's down again to 40. So because the higher rate came down to 40, so they're keeping it at 40 now.
Everything that's in that book so is relevant for this exam.
Yeah,
As in like the grades and stuff.
That's it.
Yeah.
Right, and that.
everything, yeah,
So it's all up to date for this year.
yeah.
The 33% and that's the end of the conference.
Yeah, that's it then, yeah. So do you want to do an example of one, just so we could have one? If you go to page 13 of the question pack, page 13. Okay, so Adam disposed of property in March 2014. He had purchased the property for 200,000 in July 1999. He incurred legal fees and auctioneer's fees of 3,100 when he purchased the property, and he sold it for 385,500 and incurred fees of 5,950. Okay, so we start off with Adam. Okay, we're presuming now this one there's no other gain during the year. There's only one gain. Okay, so start off with our proceeds of 385,500. Okay, less our incidental costs. Okay, which were 5,950. down to 379,550. Yeah? Okay, then we've got our costs, and it was in July 1999. So that's falling in between April 99 and April 2000, isn't it? Just to get the rate, July 1999, 2000, 1.193. So I'm going to the 5th of April 2000, so it's between the 5th of April 99 and the 5th of April 2000, and across the last one, 1.193. It's usually good just to work out your indexation factor, Joe, before you actually start doing the costs then. So we've got a first property cost 200,000. 200,000. And we've got cost. He incurred legal fees and auctioneer's fees of 3,100 when he purchased the property. So plus incidentals. And that is how much? 3,100. So you multiply 203,100 by 1.193. So 203,100 multiplied by 1.193 gives us 242,298. Yeah? Like our 379,550 less our 242,298, which gives us a gain of 137,252. That's our exemption of 1270. Okay, which brings us down to 135,982, and then that's by 33%. $44,874. Yeah? So he sold that in March 2014, so he's paid tax on it by the 16th or the 15th of December 2014, and returned it to the revenue by the 31st of October 15. You'll make a return for it. So we're just paying the tax. I mean, you pay the tax by 16th of December 14. That's your liability out of the way, but you actually have to make the return as well. If you don't make the return, you're leaving yourself open for the late filing charges. So like you say you didn't file it until the 16th, you'll be charged 10% onto that, which is €4,487.
So you pay by the 15th of December, but you make the return by
31st of October 15.
14.
15. You
So
sold
you pay
it.
it by the 4th.
Yeah,
Okay,
16, you paid by the 16th to 15th of December 14.
You pay the,
Which has to do
And
from
you,
here to file.
then you file the actual
File it.
return by October 15.
But like you imagine file it at the same time you're paying it anyway.
Yeah, a lot of people do just fill up a CG1 form and
Yeah.
send it off, just so you won't be
It
caught.
would make more sense to file it first and
it's
then
like
pay it.
self-employed thing,
Yeah.
because you haven't got the full year done.
Yeah.
So,
Yeah, like
Okay.
Joey, your accounts, your 14 accounts into the revenue by 31st of October 15, but you pay your preliminary tax by 31st of October 14.
That's revenue.
I have to get a table on the fridge. Excel sheet. Oh, don't even try, it's a question.
You still have 2 months left in the year, so you can't get something new.
So you're paying 100% of the liability you owe for that year then, like, for income tax. But here, you know how much tax you actually have to pay.
I'll have to go to
Will you look at the next one there, please? Okay, so Liz disposed of a house that she had purchased in February 1972 for €4,200. Okay, and she rented the house for the entire period of ownership. And the reason they're telling you it's rented for the period of ownership, you won't be thinking of principal private residence, you actually liable for the whole lot. The value of the house at the 6th of April 74 was $6,400. So why I give you the 6th of April 74 is because there was no CGT before that, so it's the date at the 6th of April 74 will be our cost figure. So we ignore the 4,200 and we take the 6,400 as being our cost. She spent 40,000 on new windows and roof for the property in March 1995, so that's enhancement expenditure. And she sold the property on the 3rd of April 14 for 320,000 and paid legal fees of €1,800. So we have our proceeds of 320,000, less legal fees of 1,800. Okay, so proceeds less our incidental costs. Okay, we've got our cost on the 6th of April 74. That's the very first one there on top. 7.528 is our rate. And how much did it cost us? 6,400.
So you're saying there that you're not taking when it was purchased?
Yeah, Jake, it's 70 because there was no capital gains before 6th of April 74.
Oh,
So 6th of April 74 is your date you go from. Yeah,
so everything was revalued at that point?
at that date, yeah. Okay, so it's 6,400 multiplied by 7.528. Which gives us 48,179. Yeah? Okay, that brings our price down to 270,021. We also now have enhancement. In March 95. That falls into April 95, doesn't it? Which is 1.309. so our enhancement is 1.309 figure. So we'll have 40,000 multiplied by 1.309, isn't it? Which is 52360. She has the gain of 217661. Presuming she's no order gain. To go for an exemption of 1270, and then we multiply that by 33%. To get 71,409, yeah?
You take a bit, keep used to that.
Yeah, we'd be used to this.
I think
Yeah.
it would be good.
And if you look at the next one, I'm not going to go through now because they're all the same. She purchased a property in July 1970 for 25,000. The market value, 6th of April 74, was 32,000. So it's the price at the 6th of April 74 we'll take. Then she built an extension on the property in August 1984 for 33,000. So we'll have enhancement expenditure there as well for August 84. Okay, but what I'm going to look at there is we go to the very last one. Paul sold an apartment to his son on the 15th of July 14 for 200,000. He purchased the apartment in March 1999 as an investment for 180,000. The market value of the apartment at the date of sale was 310,000. So he sold the apartment to his son for 200. Market value was 310 plus the 310.
Suppose it's 310 and then
Yeah.
the sub pays on 110.
The
So basically,
yeah, there'd be a different tax in, yeah. So we put in here, I'll just do that one there. Okay, and that is who we call. Market value is 310,000. And the reason it's market value is because it's connected person. If he sold the apartment to me, who he didn't know, for 200,000, even though it had a market value of 310, he'd only be paying tax on the 200,000 then. Okay, it's because it's a connected person, it's the 310. Okay, there's no incidental costs. No incidental costs here, all we have is a cost figure, and that is what, March 1999. So March 1999 is April 99 is 1.212, and it was how much? 180,000. Okay, so 180,000 multiplied by 1.212. Okay, so we've got 91,840 is our gain. Assuming there's no other transactions. brings it down to 95.70, and by 33% is 29,888. Okay, because the part in there is market value between connected persons.
What's a connected person, like would it be an aunt, an uncle?
It says anyone with a lineal descendant, it's actually over here. It says lineal descendant. The family members, husband, wife, brother, sister, uncle, aunt, niece, nephew, lineal descendant or ancestor, a relative or a husband or a wife of the relative, and anyone connected with a spouse.
So anyone that'll be connected to,
So,
say, my wife's nephews or
Yeah.
so wouldn't actually be my blood nephew, but
yeah,
the same thing.
she's connected, yeah.
What if they divorced?
Sorry?
What if there's a divorce in the middle of it?
Yes, never mind what would happen then if it's
Twice
divorce.
removed.
I suppose if it's a legal divorce separation, I mean,
That's
Not
not
catching it.
separate, like you're gone, like long gone to the courts, but like if you're just like living apart, do you know what I mean? We'd have to prove it.
Yeah.
But if it's actually
Did you say
legal,
it came up with a question?
no, someone were doing capital tax last night as well.
Or-
Last night, Monday night, and same thing. Someone said they were divorced. And if you look right above it there, Michael inherited a property from his father during 2007. His father bought the property in 1990 for 52,000, and the value of the property Michael inherited was 350. Sold the property in December 2014 for 370. So we ignore there his father buying it, and we take the cost as the 350. But this will have more. This is like just purely simple capital gain tax now. When we're doing these later on, there'll be other if buts and ends to that kind of a statement.
Could you not just leave us thinking we were laughing?
Then Paul purchased a commercial premises and investment property in November 96 for 236,000. During March 2001, he spent 30,000 the following: general repairs 7450, and a new roof and windows for 22,550. So the general repairs wouldn't be looked on as enhancement, but the new roof and windows would be looked on as enhancement expenditure. Okay, so general repairs, no. The new window, like they're totally replacing the windows and the roof and the windows, yeah. So repairs, don't qualify as enhancement. It has to be enhancement, like.
So to improve this.
So yeah, like we're replacing the whole windows and replacing all the doors, replacing the roof. That's big enhancement, like.
Replacing glass and broken window wouldn't be.
It wouldn't be, no, it would be your repair.
Unless it was double glazing, maybe.
Well, if you have to redo the whole house, like then,
Or
not just the one,
One window
yeah,
would
you'd have to do the whole lot. Okay, so that's just the computation for it. So if we go back to your theory notes there again in a minute. Okay, that's just there on page 14 and page 15 is the computation rules, which we just have done there. I think it's actually easier to just do them out like that and actually reading through it. And if we just watch on the bottom of page 15 there, your market value rules. So, in certain circumstances, the market value of the asset, the date of transaction, must be used instead of the amount paid received for the asset. So, assets which you give away, gifts, assets disposal for non-cash consideration, assets disposal to a family members, including connected persons, and where an asset is inherited, it is deemed to be bought for the market value at the date it is actually inherited. And if you want to cross-reference that back to page 1, I actually got done in a little box there, the fourth box down, just as a bullet point. Market value is used for proceeds figure if assets are gifted, assets are disposal for non-cash consideration, and assets are disposal to family members. And then where an asset is inherited, is deemed to have been bought for the market value at that date is actually inherited. So you're looking at market value for proceeds in the third last box, and then market value for cost on the second last box.
Does it virtually mean someone has to die?
Someone has to die, yeah. Otherwise it's called a gift. And we'll be doing that with the capital acquisition tax.
So back in the questions there, number 6, like you inherited property, so that's not a gift, that's actually inherited.
That's an inheritance. Yeah,
It's
that's just purely just
Yeah,
making an
yeah.
easy example for that one, but
That's basically his father died and
he's got the he's got the
It's
farm.
not a gift, so.
Yeah, but he's got an inheritance. And we'll be doing that further on, where we'll be looking at farmer tests and stuff to see a farmer and he could actually get the land. He wouldn't have to pay any capital gains tax maybe when he sells it and stuff. There's, you know, it puts an end, and this is as normal for tax like. But tonight, we're going to do that tonight. All I want to do is just to get the basics up and running in the heads again for capital gains tax. Okay, if you go to page 16 there. Okay, the top one we've looked at for annual exemption, and then after the 6th of April 74, I've written down manual there, but if you write in assets purchased before the 6th of April 74, and the date, the cost date is at the 6th of April 74. You don't look at the date before that.
How do you know, like, if they just make up the cost, they have an index figure, they just say, well, this is that. So they cost £4,000 in 1972. How are they getting up with £6,500?
In the real situation, I don't know how they do it. They're supposed to have everything was supposed to have been valid, but it's like probably used an indexation factor probably was given out on that date.
There was a big jump in the 70s. Like,
Yeah, up into the, yeah.
Like something that was built in the 20s, that was bought in the 20s and wasn't sold in now.
Yeah,
Like
yeah.
how will I value that back to 1974?
It's usually solicitors do this, not accountants as well, so we put it over onto them. But if it's normally like accountants don't do that much.
Yeah.
Tax consultants now would, but normally solicitor would get everything in, you know, and through the inheritance and just do all the capital gains tax and stuff in there. Yeah, there must have been to do it from when it came up, like yeah. It was like even our house at home, my dad's house, like he bought that for £1 a week for 10, because there's so much rent tax being paying on it. He bought it for £1 a week over 10 years. He couldn't pay the £10 for the house. He had to pay £1 a year for 10 years.
My parents in England, it was like they paid something like £2,000 for it or something in 1970.
Because there was so much rent paid, or was it?
No, it's just it was the value of property.
Value of property
It
time.
was a 3-bed semi, and when they sold it, they bought their next house in 1975, I think, and £25,000 or something.
Jeez.
There was that much of a jump in the 5 years.
Mad, like, isn't it? And look where they've gone now. What think about now?
No, actually,
Yeah. Okay, so bottom of page 16 is our indexation relief. And to go to top of page 17, the important thing about indexation. Indexation cannot increase the loss, it cannot increase a gain, it cannot turn an actual gain into a notional loss, and it cannot turn an actual loss into a notional gain. And I'm doing examples of this, it's like it can't, do you know what I mean, do any of those 4 things. So if it's, do you know what I mean, say you bought something for 10,000 and you sold it for 8,000 and you indexed it up and the indexation gave you a cost of 12. Yeah. You can't get money back. It's actually increasing it by €2,000. So you can't increase your loss up.
You use the actual figure.
Use the actual figures in, and that's especially in share questions. The indexation increasing it, you look at your actual figures. And I said there is a good few shares inside in year exam questions as well. So we could do a good lot of work on them.
We did a shot in
Yeah. They're guaranteed every year on the competition one. You definitely get shares every whole year. So if the application of indexation or market value rules increases the amount of a gain or loss, the lower actual figure must be used. Okay, not uses, used. That's just my typing. If the application of indexation or market value rules turn a loss into a gain or a gain into a loss, there's a no gain, no loss situation. So if indexation turns a loss into a gain or a gain into a loss, we say there's no gain, no loss. So you actually have no
So if you have a gain
liability.
of an actual gain of 2,000, like you're saying, and so if you bought it for 8 and sold for 10, and the indexation is up to bought for 12
Yeah.
and sold for 10, there's just no gain, no loss.
Yeah, and you go back to you do what your actual is, and then if one was a gain, one was a loss, you have a no gain, no loss situation. And it's like that we know when we do a few share questions, it'll make it hopefully a bit easier. Okay, then we've got losses. Okay, losses. Okay, losses of capital gains are calculated in the same way. Losses for capital gains are calculated in the same way as a gain. Can offset losses arising in a tax year against gains arising in the same year. The following restrictions apply to the use of losses. Any losses not used in the current year of assessment can be carried forward against future capital gains. Capital losses cannot be carried back, okay? So capital losses cannot be carried back. When losses arise in a year or carried forward from an earlier year, they must be used in propriety to the annual exemption. So you use your loss first and then use your annual exemption. You wouldn't take off your annual exemption, then take off your loss and actually spare your losses to carry forward to the next year. You must actually use the loss first, and then if you've got a gain, then use your annual exemption. They will be offset against gains first, and the annual exemption will only be used if there is a gain remaining after offsetting the loss. Losses arising on disposal of assets to a connected person can only be offset against gains arising on subsequent disposal to the same connected person. That's important because, like, if you made a big loss, which could happen with a connected person, okay, you can't use that big loss against the other gains you've actually made. CGT withholding tax provisions then. Tax deducted is treated as a payment on account by the vendor in respect of CGT payable on the disposal. It is possible to avoid the withholding tax charge by making an application to the revenue for a CGT clearance certificate. It must be made to the revenue in advance of the disposal taking place. A CGT clearance certificate will be granted if the vendor is resident in the state, is not liable to CGT, or the vendor has paid all the CGT due. The main purpose of the scheme is to ensure that revenue collect taxes due when a non-resident individual sells property in Ireland. However, any individual selling property is subject to the withholding tax unless she or he has a CGT clearance cert. And if you look at the next page there, it actually tells you which ones actually apply for CGT or for the CGT withholding tax. So where there is disposal of specified asset, okay, or specified assets, there is an obligation on the purchaser to deduct withholding tax of 15% from the proceeds before paying the proceeds to the vendor. So withholding tax only applies where the proceeds exceed 500,000, the sale of one of the following classes of assets: land and buildings in the state, minerals, exploration rights on the Irish continental shelf, unquoted shares deriving their value from any one of the above, and goodwill of a trade carried on in the state. And it's like the main was like for people who are not living in Ireland, who are they must actually deduct the tax there, so the revenue at least they're getting 15%, even if they make no other return, they've got 15% of the liability anyway, even though they should be getting 33%. Okay, then transactions between spouses.
So is that like if you're trying to buy a house off you for 100,000,
Yeah.
what I'm paying you, one solicitor or whoever it is, will hold back 15% and pay to the
And pay to the revenue. Yeah, yeah.
And
And then your liability says 33,000, then 15,000 has already been paid, and you only
You can't
pay
pay
18.
33% and you take away the 15.
Yeah, you take 15%. It's 15% from hold back the 15% from the proceeds. So however the amount, so it's like 100,000 it costs you, you're selling it for, so 15,000 off it straight away.
That's off the proceeds.
Off the proceeds, yeah.
But you get that back when you pay your CGT.
Oh yeah, yeah. You pay it properly.
So you actually calculate it proper, and then you pay that, and then you get the refund of 15%.
Yeah, or else you can put the 15% against your liability.
What it was.
Yeah, and if you've overpaid in, you get the difference back.
So you calculate on the full amount regardless, without ignore 15% of your calculating.
Yeah, that's it.
And it's the buyer holds 15% back. So if I buy
The
something,
buyer, yeah,
if I buy something from you, I hold 15,000 back, say.
yeah, that's it, yeah. And you hand it over to the revenue. So you give him 85,000
Yeah.
and you give 15,000 to the revenue. And where an asset is transferred from one spouse to another, there is no gain arising on the transfer. Okay, so when a spouse transfers to another spouse, there is no gain or loss arising on the transfer. This is achieved by deeming that the spouse to have acquired the asset at the date that the asset was purchased originally for the original cost price. This will be used to calculate the capital gain or loss arising on the disposal of the asset to a third party. Then you've got losses, where a husband and wife are jointly assessed. Capital losses of one spouse may be used against the capital gains of the other, and this applies to current year losses and losses carried forward. So you can actually transfer losses between the spouses. The annual exemption, you can transfer the annual exemption is not transferable. They must both make a gain their own right to use the annual exemption. So have everything in joint names.
Yeah.
If it's, do you know what I mean?
Okay.
If you sell the house or the land, then everything is in joint names, so you both get the 1270. Have the shares in joint names as well, if you had shares, like. And calculate CGT liability for each separately, so each one is done out separately. Okay. Okay, chattels then. I actually have done chattels on the front of it, I think, which actually would be easier to look at. So we're actually very front of that pack again now. See on page 3, I've given you the losses just on a note form as well. And at the bottom of page 3, I've given you the CGT withholding tax rules just on note form as well. And if we go over to page 5, we've got chattels. So we've got wasting chattels and non-wasting chattels. It's 8:10. Do you want to take 5 minutes there before we go on? Yeah? I didn't realise it was actually